From Monday, November 1st to Wednesday, November 3rd, Zillow stock dropped from $102 a share down to $63 a share, a $39 loss over a 3-day period that rocked the company. On Wednesday, Zillow announced that they would be shuttering the iBuying arm of their business and firing 25% of their workforce. This led to the most dramatic day of losses, with shares crashing 25% and Zillow losing billions of dollars of market value. This announcement shed a light onto one of the most brilliant but risky business attempts to control the housing market that had ever been attempted. This is the behind-the-scenes story of Zillow's highly leveraged foray into homeownership. City by city. Zillow launched their iBuyer, branded to the public as Zillow Offers, in Phoenix, Arizona in 2018. It joined the bustling housing market in Arizona, competing with real estate agents and other iBuyers, Opendoor, and OfferPad. The idea is simple. Leverage the power of big data that Zillow has already compiled and controls with their valuations of every property in the United States and combine it with the company's massive financial backing. Zillow can offer lower prices than traditional buyers, but can lock in deals and execute quickly by promising fast, all-cash transactions. Let us use the story of Gary Bird, a 59-year-old community college campus facilities supervisor, to illustrate how this process would work. Bird clicked on a Zillow pop-up ad one day to get an offer for his home, which he'd recently bought in 2017 for $156,000. The housing market where Bird lived in Tampa, Florida, had skyrocketed since then, and Bird was hoping to take advantage. Bird entered into an initial conversation of interest with Zillow, who sent an agent to his house. The agent did a walkthrough, taking measurements of every conceivable area and shooting video of the entire property. One day after its inspector arrived, Zillow returned to Bird with an offer. In total, it took Gary Bird 6 weeks to close on his house. The median time in the US to sell a house ranges from 11 to 15 weeks. Gary's whole process started on Zillow when he clicked a pop-up box that said, "We buy homes." Just weeks later, Zillow owned his house. The business behind the business. Zillow's business idea was superb, but it was also predatory in nature. In what is usually a very personalized and complicated business transaction, Zillow makes the relationship corporate and pain-free, for a price. Zillow would lowball customers because they offered convenience and liquidity. Zillow didn't demand you to list your home with professional photographs. They don't do open houses or showings, and they don't demand repairs or drawn-out closing processes with negotiations that can last for weeks. Zillow put lowball offers on the table in front of customers and could promise an instant sale. It's why tens of thousands of sellers across the United States signed on the dotted line with Zillow, giving up their homes for offers that were typically tens of thousands of dollars below market value. It's a cold and calculating strategy designed to work to perfection by a team of big data engineers at Zillow that would transform the power of the company in the marketplace. Walking a fine line. Zillow's iBuyer doesn't work in every housing market across the country. Zillow's iBuyer draws a line around and through certain communities in the United States. The iBuyer will only attempt to operate within those geographical boundaries. It's a strategic move necessary to make the iBuyer work. Because Zillow targets at least a 5% profit on each flip, they have a low margin of error in their acquisitions. The iBuyer works best in highly uniform, predictable markets. These trend toward cookie-cutter style, modern properties. In neighborhoods where an algorithm would have difficulty picking up on poor value houses, Zillow loses. While the iBuyer is one of the most advanced pieces of technology ever to enter the realm of the real estate market, it cannot account for the expertise of a seasoned real estate agent. Zillow prioritizes speed over accuracy, cash and financial might over touch. This means that while they can throw cash to get at sellers to get the deals done, they miss out on housing attributes that slip through the algorithm. For the iBuyer to work, it must close offers quickly. However, they must also price their houses precisely to avoid incorrectly valuing homes. Offering on houses quickly means that there's less time for Zillow to understand the housing market to make those critical, correct price predictions. Zillow was a company with ambitious goals. They had the Zestimate, which already had provided pricing estimates for millions of homes, giving them an unmatched back supply of data to work with. In Phoenix, Arizona, where Zillow launched their iBuyer, they continued to up the ante. It had perfect neighborhoods of cookie-cutter properties in a hot housing market. They were racing towards completing 10% of all real estate transactions in the city. By October 2021, Zillow recorded its most active week buying homes, part of its goal to buy 5,000 homes a month by 2024. When computers fail. Sometime in October, the buying suddenly stopped. Zillow CEO Rich Barton told analysts at the company's Q3 announcement that the company closed the doors on its buying arm and would lay off 25% of its employees. Barton told analysts the premise of Zillow's iBuying business was being able to forecast the price of homes accurately 3 to 6 months in advance. But the forecast proved inaccurate in 2021's gyrating housing market. In the second quarter, Barton said, Zillow actually was able to sell homes for 5.8% more than it expected. In the third quarter, though, Zillow sold homes for 5 to 7% less than it forecasted. Translation: in a business completely predicated on a big data buying and selling model overwhelming individual real estate agents, the algorithm lost and lost in a big way. In September alone, Zillow was buying homes at a higher price than the market average. $65,000 higher, in fact, in September. In Phoenix in September, the problem stood out. 9 out of 10 homes that Zillow bought were put up for sale at a lower price than the company originally bought them for. For an algorithm that was built on speed and with the purpose to lowball homeowners in order to get a quick deal done, the computer formula had completely flipped on itself. Zillow got greedier and greedier, expanding the boundaries of what they thought was possible. Combined with the complexities of the COVID-19 pandemic and the algorithm being unable to adjust for consumer behavior, Zillow ran head-on into a wall. The little guy can win. In a world that seems increasingly controlled by big financial firms, technology companies, mainstream media, and now big corporations using computers to infiltrate the housing market, this is a story of the little guy winning. In the story of Gary Bird in Tampa, Florida, Zillow offered $235,000. That's a 50% increase over what Gary paid when he bought his home 4 years ago. It was well over $30,000 more than what the other iBuyers were willing to give for his home. It is a story of success for an individual homeowner who, when the computer algorithm could not keep up, was able to get a great deal for his family. Zillow's technology takeover attempt shows that we have not moved as a society to the point where technology can replace the in-person home buying process. While Zillow failed and paid the price dearly, there will undoubtedly be more who come along and try to replicate the iBuying process at scale. Homeownership and real estate are such fundamental pieces of the American dream, it's not just a matter of who, but when it happens.